It's funny how I always get a sense of anxiety every time I go into these, and I've got to remember it's just another show, and
Yeah. Well, hey,
yeah.
yeah. Welcome to the event. See, you got Kip coming in, Charmaine. We said you guys are front row seat. So you about ready, Alf? You feeling good?
Yeah, I'm feeling good, Kirk.
Yeah. Joe says there's a city next door. I'm in Washington D.C. and there's a city called Jessup, right outside of D.C. near Baltimore. So Joe, is that your city? Hey, as you come in, put your location, your city that you're in inside the chat box, and that way we know who's here and we can adjust the conversation. There might be even better examples if we know where you are from at the moment. Wendy Roberts, welcome to the event here. Newport Beach, California. Yeah, just midday for you all, huh? We got Alf is in Australia. That's where we're
Hello from down the deep south.
Real deep south.
The really deep south.
Yeah, we're gonna get started in just about a minute here. So people come in.
So Kirk, have you got everyone on mute at this point?
Yeah, there's no people can chat, but there's no multilateral conversation, just so that we keep it useful.
Yeah, great.
Right, Taiwan, very nice. Scott, how did you end up in Taiwan? What's going on there? Are you from Taiwan? Because with your first and last name, I'm thinking you're not. Yep. Yeah, New York Metro, very nice. We got a couple of growth CFOs up in New York. It's great place, lots of good companies to work with. So multi-stay, Nevada to very nice, Taiwan. I bet there's a good story there, Scott. It's good to see that people are getting out and doing things, right? To take our country. Atlanta, that's one of my favorite cities. Somebody give me a reason to go there and visit. It doesn't take much.
We're going to have to give you a reason to come down to the deep south at some point, Kirk.
I'm ready. I'm ready.
When we're allowed to fly again.
Yeah, that's right. You and I met for the first time in February. Then it seemed like after that, the whole world shut down.
Absolutely.
You know. So why don't we kick it off? Alf, you ready?
Yep, that'd be fine.
Right.
All right. So just to kick this off, welcome to everyone on our webinar. I'm Alf Priestley from Melbourne in Australia. As I like to say to Kirk, I'm from the deep south relative to his fine country up there. And today's webinar, we're really drilling into the habits of profitability and how we can really develop financial strategies to thrive. And I think the best way to start this, as per the slide here, is to think about your why. Why did you actually get into business to begin with? Now, when we've surveyed a number of people, both in the US and here in Australia, there's a range of reasons for that. They could be mountain climbers, really inspired by an idea, or maybe they're a freedom fighter, that they really wanted to have more time and money to do things that matter to them. Or they might have had a cause that was really important, something that really mattered, and they wanted to build a business around that. Yeah. Also, or for some people, it's really to really get a job. They couldn't find a job anywhere else, and so they created their own business in order to effectively employ themselves, give themselves something meaningful to go forward with. Or maybe you started off and you stepped into a family business, as I did 35 years ago into my family's business, which subsequently I've come out of. But that could be a reason. You're actually part of a family business, or perhaps it's about multi-generational wealth creation, that you're really looking to have an impact into the future for multi-generations. Yep. Now, the reason this is so important is that it's really important that you're clear about what your why is, so that you have a reason to make the content that we're about to run through relevant to you. When you're clear about your why, the relevance of this material is going to become more pertinent. So next slide there, Kirk. So the analogy I'd like you to think about here is just to imagine that you're, as a CEO of a business, you're like a jet fighter pilot. And I think it is a really good analogy that you've got this machine around you, and within that machine, you've got really good visibility. So you can see this jet pilot flying there. They've got a scorecard in front of them. They've got all of their instruments, giving them a really good idea about what's happening inside their machine, their business, but also external threats. So you've got good visibility out the front of the windscreen there, but you've also got visibility beyond that. You've got radar, so you can perhaps look at things, threats that might even be beyond the horizon, your natural sight. So when you've got good visibility, it means that you can fly, you can adjust, threats can come out of the ether, and you're able to create and adjust as you go. So visibility is critical for a jet pilot here.
Yeah. Hey, Al, for what it's worth, that's what it feels like. I mean, by 6 a.m. in the morning, we're getting up as a CEO and we're hitting it hard on hopefully clear objectives. What do we want to get out of today's work? So I can totally feel it.
Yeah, absolutely. Next slide there, Kirk. And just to contrast this is what happens when we haven't got visibility. Either something potentially can go wrong within our existing business, that we've got some fuel issues or we've got some control issues within it, or we have a threat that we can't adjust to. We didn't see the threat and we couldn't adjust to the threat. So this is the sort of other side of high flying, is that we can also be shot down in the process. So next slide there, Kirk. So the key element to this is that we really need to have a wing person, that if you are a jet pilot, you didn't do it by yourself. You really need to have a team around you that can really help and support you on that daily mission. So we've got people on the ground, we've got people up in the radar, we've got other flight members. So it's really important that we've got a collective team, that we're not just trying to be a sole individual out by ourselves, that we recognize that this is a team effort. It's not just an individual doing it all by themselves. So next slide, Kurt. And this principle of operating as a team is not something new. If we look back through the very highly regarded books in the past, each one of these talks about having really operating as a team, where we've got the right guide, the right people, and we really use the numbers as our scorecard to go forward. So you've got Peter Drucker here, Jim Collins, and all the way back even to Napoleon Hill back in the 30s. All of them talk about the value of having a board or a team, and to effectively collaboratively operate as a team for the business going forward. Next slide there, Kirk. And again, this is just a reminder, is when we don't have that right guide, people and numbers, that there is a great possibility of really being taken out by something that we didn't expect. So this is certainly increases the odds of that without the right people, guide and numbers.
Yeah. Alf, we're definitely seeing this now. I mean, there's businesses that were, if they weren't flying high, they were flying well, January, February, prior years. We always have our business challenges. But all of a sudden, overnight, with COVID and things being shut down and supply chains being disruptive, we're seeing, some real concerns with certain businesses where they may not be here tomorrow, especially as the government stimulus runs out, which it's gonna stop. And so there's a lot going on. So that's a good visual. When the cash runs out, it's like the fuel in a jet, the plane drops. So
absolutely, yeah. And I guess, like you mentioned, the government stimulus there, Kirk, at some point, this money's got to be paid back, or the other alternatives, we're going to enter hyperinflation.
Yeah.
That really this is, in order for governments to effectively nullify the amount of money that's being given out, it's very possible that we'll enter into a phase of very, very high inflation rate. And really, how do we go about adjusting to those sort of new challenges, something that we haven't experienced for quite a period of time?
Yeah, in the U.S. it's been like the 1970s with the oil shocks. The last time we had hyperinflation, and countries like Venezuela that have 3 million% inflation, that's normal. They don't even use their currency anymore. But for the U.S., that is not normal, and it is $10 trillion put in that stimulus. It is definitely coming out. It's definitely going to hit inflation somewhere, no question about it.
Absolutely.
Yep.
So next slide there, Kurt.
Yeah, so let's find out who's in the room here. We got a small, intimate group, which is fantastic because it means that each of you, if you got questions or thoughts that you want to share, put them in the chat box, and we'll, it's my job to monitor the chat box. I'm Alf's wing person, and I'm gonna bring your questions to the group and discuss it. So definitely put your questions in the chat box. Let's see if we can get at least 80%. We've got a small group. Everybody's accountable, right? If you don't vote, you still made a choice. All right, isn't there a song that says something like that? So if we get at least 70% would be great. Okay, 2 questions. One is, and by the way, this is anonymous, right? We'll see the statistical result, but you're not going to see anybody's name associated with it. So what was your top line revenue last year, 2019? And what do you expect this year with COVID? Do you expect your revenue to increase, decrease, stay about the same? And in previous webinars, the responses have been actually surprised me. I mean, they were different than what I expected. Okay, a few more seconds, right? 60%, 9 out of 15. Anybody else want to jump in and get us to 70? Okay, going once, going twice, sold. I'm going to wrap it up and share results with you. I mean, just take a look. I mean, 44% expect revenue to increase. I mean, that is better than the average expectation across companies globally. 11% decrease because net, the economy, literally the economy is shrinking, right? So the approachable market in your sectors is shrinking. Now, obviously, different sectors, different things. But look at this, 40. I mean, almost 90% is saying the same or better. That shocks me. Even with a much larger group, we had a similar result. It just shocks me. What about you, Alf? Any surprises?
Yeah, it is a surprise. I've heard from a number of different groups, if you like, who have CEOs that that they seem to believe there's about 20% increase of their business owners, their CEOs have increased, or they expected an increase. And the vast majority of the others, there may be 20% that haven't changed, but all the rest, they anticipate some sort of hit to their revenue going forward.
Something. Really interesting. So let's put things into high gear here. I want to establish, the habits of profitability. This is one way, I'm going to argue, one of the best ways to gain clarity about your business, and make decisions with confidence. You actually have the numbers between, option A versus B, and you're executing with the numbers. So just like a flight plan, you can see if you're over or under early. So even that week, that month, you have a chance to, know where to lean in and do the work to get things on track before the month is over, right? So that it's that leading indicator that you can still act on. So the habits are making sure that you have good numbers, manage your cash well, identify the right growth options, and create your financial roadmap, right? And then the last one, kind of a surprise, kind of a cliffhanger, shake up possibilities. So let's see what that means, because you don't want to be locked into, having blinders on and thinking only one way when there might be other options to at least consider. So here's the first habit. Make sure that you have good numbers, right? This is your foundation. If you keep with the air, the fighter jet analogy, this is your runway, right? This is your control tower, so you know what's coming and going. It could be an aircraft carrier if you're launching from that kind of platform. So, I mean, what would it be like? I mean, from a CEO standpoint, what would it be like if every month your managers came to you in a financial statement review and they're using the numbers story like a scoreboard? And something to the effect of your salesperson, instead of telling you the next big story, the next big contract is on the way, they really get to it. And they can tell you the number story, where they're over or under the forecast. They can tell you why they're over or under, and propose recommendations about what they're going to do, right? If you're doing better than expected, keep capitalizing on that. If we're under expectations, what do we do to get back on track, right? So you can feel the extreme ownership, right? As sales managers, speaking with that level of clarity to your management team with you, and a chance for other people to add additional clarity or action items that would move the dial in the right direction, right? That's what it means to make sure that you have good numbers, right? By looking at them, the only way to make sure your financials are right is to have the P&L managers who actually do the work, know what the line items are, use the financials every month. Otherwise, you're left to what accounting thought and how they keyed something, and they may have miskeyed something. So that's how you make sure you have the numbers, and it's how you drive results, because you're cutting through all the noise, and you can actually see if you're over or under and take action. Another key component, something that complements the monthly financials, is a weekly KPI dashboard, right? Sometimes companies that are more developed and further along the pipeline, they have an electronic dashboard, but don't make that your only option. If you're just starting out to figure out what measurements matter to you, like in the sales area, what activities lead to the results you want, and are those week to week, are you over or under the number of activities to get that result? If needed, make it simple. You can start today with one number in an Excel spreadsheet, and then measure it week to week. So that either way, that weekly key performance indicators combined with monthly financials used like a scoreboard, it's a game changer, right? You're leaving the verbal tradition and going to something that is black and white that you can act on. If you're not on accrual accounting, learn about that. The only way to measure profitability is accrual accounting, where you essentially match up the revenue with the cost. Early stage companies sometimes don't do that. Later stage companies figure it out, because otherwise it's hard to price competitively if you don't know what your direct cost is. So one way that the Growth CFO and Habit One helps you win more contracts is literally by matching up the direct cost for every unit of service, so that you can price more competitively. Then if your teams are delivering the way we're talking about, having those numbers every week, you can still earn the profit margin you're looking for, because they're literally they're on point. If they're off, they see it early and make adjustments. So Habit One is the bedrock. Everything else, having good numbers and using them every month like a scoreboard. The next thing,
Kirk, just before you move off that, if you can just come back a slide. You've emphasized to me the importance of education. I mean, you come from a university, obviously a professor. You've spoken about the importance of actually teaching the line managers, the P&L managers, operations or sales, how the numbers actually work, so that it's not just coming from the CEO or the CFO. It's actually lifting the financial literacy of really the key leadership.
Alf, that's a good point. I'm glad you brought it up, because most of us are not taught how to read financials. And then many of us are intimidated by the numbers. We're like, there's going to be a calculus test somewhere around here. We're not going to look good. And if we're the CEO, we want to at least look good, right? Because we know it. Some days we're already up at night trying to figure things out. So that's a good point. It's a skill, right? Reading the financials, using the financials. Most of your managers probably haven't been taught. Some of them may have some exposure, but for most people, there's a next step to get even better at using the numbers, getting past some of the intimidation. Normally there's a cycle. The first 3 months of looking at financials, it's awkward, right? If they could tar and feather the CFO, the growth CFO, to get them out of there, they would. But the growth CFO keep teaching side by side, right, through actual practical use and decision making. By the 6 months, they're starting to get good, right? I teach the same thing at Georgetown University grad students, so I can see it for managers at all levels. And then 9 or 10 months, they almost wouldn't make a decision without the financials, because they are engineering profitability to go right where you want to go. So it's a skill, but doing it every month as a habit consistently, as a recurring meeting on time without delay, it gets pretty useful.
That's fantastic. Thank you, Kirk.
Yeah, I'm glad you brought that up. I'm going to make a point to mention that more often, because otherwise people think they should already know something. But why?
Absolutely, and like any skill, you've got to, any skill that's worth learning, you've got to do it badly to begin with. So it's very much about crawling first before you walk, before you run. Yeah. The expectation of a lot of people is that they can just run straight away. So I think that's a key part about knowing the numbers is to be able to learn that skill for all the staff members, not just the CFO or the CEO.
Yeah. Point taken. So let's take the next step, habit number 2. So first you got good numbers, and good numbers are really important so you can see how your cash is being used and when you want to make payments and not make payments. So cash is the second habit. Manage it well, right? Cash is literally like the fuel in that jet aircraft. The jet aircraft is moving fast, but believe me, the minute it runs out of fuel, it drops like a rock. You better hope that eject button works well and the parachute deploys, because that plane's not going, and it is not going to glide. And that's what our businesses do. If we run out of cash and can't make payroll, so one CEO told me one time, you haven't lived life until you made payroll on a credit card, right? And that's sweaty. I can feel myself waking up at night on that one. So cash really is king. You will never see a business go out of business for low profit or no profit. But when it runs out of cash, because cash and profit are not the same thing, when it runs out of cash, it's game over. If you can't make payroll, tax, and keep the vendors doing what they do, then it is truly game over, and it's really stressful. So more than ever, right, with some of the shifting and the uncertainty that's going on, we're talking about conserving cash, right? Pay your vendors when you're supposed to pay them, but you don't have to pay them immediately, right? Pretty much do unto others as you want them to do unto you. If you have the wherewithal, you want to keep paying your bills, including rent. You can definitely, with financial institutions, right? Like vehicles, even rent, you can negotiate different terms. But we're doing a lot of debt restructure right now, where when you're open, when you have a view forward, you can forecast forward, which we'll talk about in the fourth habit. Then lending institutions have a lot of flexibility. Some of them can do switch from principal and interest payments to interest only, and then agree not time-based, but agree when you're making a certain level of profit again, then we start paying principal. So it's event-based, not time-based. There's a lot that can be done now, because it doesn't help anybody not to be in business anymore. And then there's lots of federal and state programs, like the infamous one is PPP, which it's rocky, but it was designed to get billions of dollars into the hands of businesses fast, and so it did that. And now there's lots of clarification with the rules, and under certain circumstances, you can have that loan forgiven where you don't pay anything back, so it becomes a grant. So if you have PPP funding and don't know about it, if you have PPP funding and don't know about having it forgiven, look it up or email me or Alf, and we'll help you get some answers about what's available to you. Okay, so cash is where it's at, no question. Here's one of the key tools is you use a 12-week cash forecast where the top section shows cash coming in, and the bottom section by your key vendors, cash going out, including payroll tax, income tax payments. And some of the payroll tax you can defer until future years if you need to do that. If you're able to keep up on payments, it's probably better if you do keep up on payments. But it allows you to match things up. If cash is not coming in as fast as you need it to, you can change on your 12-week forecast when you pay certain vendors. So this 12-week forecast becomes the payment instruction to your accounts payable department when to actually issue the check. And hopefully you're not actually issuing a check. Hopefully you're doing things electronically, because if you issue a check, you gave everybody who looked at your check, you gave them everything they need to commit bank fraud against you, but that's another story. So the metaphor. So from a cash management standpoint, doing the 12-week cash forecast, get it down on black and white where you can see where you have surpluses and shortages, and change the timing to line things up. For some people, game changer if you're not already doing it. In all these habits, you can start if you're not doing it, start with just doing the bank balance every Monday, and then forecast out 2 or 3 or 4 weeks. But when you're really game on, you got 12 to 13 weeks of visibility. Okay. Alf, any thoughts there about cash? Any stories or anything?
I just know here in Australia that how important it is to ensure that we've got adequate cash and even cash reserves in order to make sure that we can meet our obligations when they're required. But it also provides a great sense of comfort. And I believe that when a CEO has their cash under control, they are far more effective, far more productive, and far happier at work than they are when they're running under cash pressure, trying to make payroll, that sort of thing. So just for their own well-being and the well-being of the team, to have cash in place makes a big difference to your overall well-being and the way that you interact on a day-by-day basis with vendors, with staff, with customers. I think it makes a huge difference.
Huge difference. The bank is full for whatever that means for your business. It just feels safer. So the cash forecast is like visibility with the jet fighter. It's looking outside the canopy and seeing what's in front of you, your radars, your instruments, your dashboard. You can actually see what's coming across, a pretty long, pretty reasonable distance. The next one, and this is one that it kind of strikes me. A lot of financial professionals don't do this, and what I'm talking about is measure the cash conversion cycle, right? And this is literally, you measure how long from when I do the work to when I bill the client. How long is that? How many days? And when I bill the client to when I actually get cash in, days sales outstanding, how many days is that? And all the way down the food chain to vendor payments and inventory. How long is that inventory actually in my warehouse consuming working capital because I haven't sold it yet? So, the cash conversion cycle, I swear to God, I've seen very few financial people actually do this for whatever reason, but this is like the instruments or the measurements of what's going on inside your machine. How is your machine working? Billing to collections, the kind of stuff. And you can see from the example, if my current billing time period is 21 days, if I get just 1 week better, 1 week faster, maybe instead of waiting until the end of the month to bill somebody, I bill them twice a month if it's a big customer, or weekly, right? Or prepaid, right? We're getting positive cash flow. You can see just that one line item frees up, actual example, almost $600,000 of working capital. So it's that much more money in the bank that you can pay other things with that are due. So the habit is to measure this twice a year, and then really rethink your operation. Are you doing something a certain way just because your controller is doing things in a traditional manner, but there's no other reason to do it that way besides that's the way we've always done it? Maybe rethink things, because traditional methods mean we do the work in month 1. By week 1 or 2 of the second month, we send the invoice, and for some reason people put net 30. You ever see net 30? And hey, I did the work last month, but you can pay me, 30 days from now. So now you're into the third month, and if they pay you on time, it's 3 months from when you're laying out your first expenses on payroll, material, your overhead, to when you get paid. And who thought of that model, right? Because if you do this calculation, you'll see certain parts of that you don't want to do anymore, and you're going to change up how you do business, right? So accelerate your cash. If you can, move to positive cash flow. You actually get the money up front and then do the work, right? Because my God, your life is so much better at that point, right? And companies, have done that where previously people thought maybe you can't do that, but maybe you can. So habit 3, this is where you identify the right growth options, right? If you come to webinars, in the old days, we went to workshops, you had breakout sessions, you come back from a day's worth of conferences, and there's so many options. How do I figure out which one I can actually have the capacity to implement? And how do I make sure once I implement it, how do I make sure I actually get the benefits from what I thought I would get? And so many times we implement something and the silver bullet doesn't work the way it was promised to work. So identifying the right growth options as growth CFOs, helping CEOs have clarity about growing their business. Even now, we do it through the lens, right, of these 8 lenses, and these are the ones that are proven. Not only they put more cash in the bank now, but on average, if you score 80 or plus on the 2% CEO score that we do to measure these drivers, we know for a fact that your business is 71% more valuable at that time than it would be otherwise. So it kind of makes sense no matter at what stage you are in the business cycle. If you're early stage, or if you're ready for the sunset to step back partially or fully from your business, it makes sense to measure these drivers and figure out which one can you move the dial in, because it's valuable to you. Plus, it'll make a business that operates with less dependencies, right? So like the owner's trap, where you're doing the sales, you're doing delivery, employees are coming to you, and it feels like you got the weight of the world on your shoulders. If you alleviate the owner's trap, there's less of that, right? Not saying it's easy, but if you quarter to quarter, 90-day sprints, if you work on it, it'll pay off. The consequence, if you feel the owner's trap, everything's on my shoulders, then a couple things happen. One is from a sales top line client standpoint, you can only go so far, because no matter how broad your wingspans your wingspan is still finite. You can't do as much as 10 people can, period. Assuming that they're competent and do the work. So alleviating the owner's trap, how do you take that first step? How do you document processes? How do you train up a person who actually does perform? Because a lot of times people you hire don't perform. To start taking off sales and operational responsibilities and their delivery. So you're actually building a business instead of being the business. Because if you're in the owner's trap, you are the business. It'll impact your ability to earn profit now, generate cash now. So that's today's impact. And then tomorrow, when you want to step back from the business partially or fully, if you are the business, the value of your business is dramatically reduced, right? Because if you step back, how is the business going to continue operating? So you end up getting into an earnout. On average, earnout lasts 2.5 years, where as a CEO, you have the responsibility to deliver results, but you don't have the same authority that you had before. And for the first time after so many years of being independent and free, now you got a boss. So most of the time, if you get into an earnout when you're transitioning, succession options for the business, it doesn't work out the way you wanted it to. And usually a big portion of your compensation is tied up to that earnout period. And some portion of that you're not going to see. Usually a pretty big portion. So, but if you're developing these things now, uniqueness, recurring revenue. So project revenues begins and ends. Recurring revenue keeps going, more predictable, more stable, right? Financial performance, alleviating customer concentration. If you depend on the federal government and they do government shutdown, most of that money is never paid out to contractors, right? And likewise, if you have a key customer, anything more than 20% of your revenue, you get risk. When something happens with that business, it's going to happen bigger to your business. Okay, and things do happen. Okay, so I won't go through all of these. I do have a report. First of all, you can get the score, and then you can actually have the overall measurement and the actual score for each one. So if you want that, contact Alf and I. It's a key tool for us to figure out how do we help the business grow with clarity. and we do that, we develop those drivers in the context of the full journey, from foundation things like we're talking about, cash management, having accounting, being on an accrual basis, all the way through the 7 succession options, right? If you're developing those drivers, you have 7 options available to you, so a lot more possibilities. But so that's identifying the right, the right growth options is that third habit in the context of the full journey. And a lot more effective. If I'm just making decisions today, then I'm going to probably miss something tomorrow because my decision making today isn't informed or aligned to the bigger outcome. Okay, so we're going to turn the corner here. We're going to do the 4th and 5th habit. The 4th habit is create your financial roadmap. Just like that jet fighter, jet fighters have flight plans. Those flight plans are logged into the system, and people are watching to make sure the jet is not going off. If you're going into Baghdad and you end up in Russia, not a good thing, right? So the financial roadmap is taking all your ideas, all your options to create, lead generation, marketing, to sales. How do you bring it into the numbers? Because the only thing you can measure in life is a number. You can't measure anything else. And with a financial roadmap, every month, on every project and every client and every product, you can determine, am I over or under, both in terms of the sales and then the profitability, which includes the cost component. So you create a financial roadmap and you lay out that 12-month rolling forecast. Doesn't matter what month you're doing it, roll it out. Don't stop at December. Go all the way through June of 2021, because you're creating a skill to be able to plan and execute across 12 months, which is essential to being a high-performing CEO. And once you do the baseline, the first budget, run scenarios. What if? Those possibilities. What if I concentrate on my best client and I increase my price just 1%? 1%. I don't have a value proposition to be 1% better. I should think about my value proposition. What happens if I manage my costs in addition to the 1% price increase, my direct costs 1% better. And likewise, my overhead costs 1% better. In this example, your engineering profitability, 1 + 1 + 1 should equal 3. But in this case, you increase your profitability 39%. So if you get even more focused in your ideal customer marketplace, the one that has the ability to pay you, what happens if I increase my price by 5%? I get more focus on those clients I can really help. So what if? So you can engineer profitability, and then how do I make sure I'm in the top percentile based on benchmarks in my industry? So this is your flight plan. And then once you have the plan, black and white on paper, you got your financial system, accounting records showing, are you over or under for this month? Are you over or under for the year? And how did you compare to the prior year? Because I might be doing better compared to the prior year, but I'm not beating the plan. So from a managerial standpoint, it gives you a different indicator. Okay, so that's creating the financial roadmap, right? Some people call it a budget. We call it a forecast. Budgets kind of have a administrative, non-exciting, non-dynamic feel for it. If you're engineering your financial roadmap, it's exciting. And the things you'll see is, and you might even see some costs, There's a whole bunch of costs. And a lot of times 10, 15, 20% of costs. I'm not talking about cutting people. I'm talking about cutting things you're paying for. Like, no one ever uses that one. I remember one bill alone from one client, $15,000 a month recurring. Nobody in the company knew what it was for. Nobody. But they've been paying it for years, right? At one point, I'm sure it had value, but those folks are gone. Okay, so let's come bring it home right here to the 5th habit. We're shaking things up. This is where you have dashboards and visibility beyond your company, right? What are the competitive benchmarks for your industry, right? If you go to a bank to get a loan, they have a database. They're going to see how you compare, and they're going to use that, because every industry is different, right? It's not fair to compare an Amazon Web Service tech company with somebody who might be cleaning houses, right? It's kind of apples and oranges. Probably the house cleaner has higher profit margins. So get your competitive benchmarks. We subscribe to the same database that many banks use. Because first of all, if we're getting a loan, we want to know what the banks are going to think before we take a package proposal to them. We want to make sure our proposal is strong, right? And we can defend what we're asking for. We already know where we stand to the benchmarks. Secondly, and more importantly for most of us, is invariably you're going to see opportunity in your business, right? But you're doing that number story. Like an example here, net income, the company is actually doing 2% year over year on profitability, but the average company in the industry is doing 10%. So the number story is, the average company is doing 5 times better than we are. There's no judgment. It's a number. It's information. So then why, right? I got critical thinking on why and what can we do, right? Because I don't want to be 10% average. I want to be in the 14% top 20 percentile for my industry, right? So the numbers help you break out of, whatever paradigm we're operating in, and it creates a defendable, whatever you're doing externally in the world, you got a defendable position, right? And you go to transfer the business, hey, I'm the top 20 percentile and I know it, or all the way to today. How do I drive my profitability? By doing the benchmark. You're going to see something, usually 1, 2, or 3 things that are worth working on, right? Because it's going to produce the result you need. Same example for current ratios, your current assets divided by current liability, essentially the cash you have to pay your immediate bills. That the benchmark is, you got roughly $3.29 for every dollar liability. It's pretty comfortable. Okay, so that's the fifth habit. Put it all together, it works. Like a jet aircraft, the things you need to be effective. You got good numbers, your foundation, right? You're managing your cash flow. You get the visibility, plus you're structurally improving, your basic cash cycle with the cash conversion measurements. Then you're identifying the right growth options, right? Because you're putting the different things that pop up when sales folks call you. You're putting those options through the lens of the 8 drivers, plus the growth pyramid all the way through succession options. So where does this fit? How does this align with my real priorities, both my personal and my business priorities? And then it's much easier. You eliminate the noise and then really evaluate 2 or 3 options that move the dial, and then you get that numeric roadmap. If I put this money in, this is what I expect to get out of it, and you make sure you get what you expect to get, when you expect to get it, through your financials, right? It's either, if the budget is in the financials, am I getting more or less of what I expected to get at that time? So the practices fit in quite well together. And then creating your financial roadmap, a 12-month rolling forecast. If you can plan and execute across 12 months, it's a skill. Your P&L manager, your salespeople will learn if they do it consistently. If you can do 12 months of planning and executing, now you can do that 3-year horizon. And at that point, game on. What kind of, you can strategically grow at that point. Do you acquire companies? Do you move into new territories? Do you raise capital? If you can show, no, we're really good at planning and executing, not just 12 months, which most companies can't do, that we can go for 3 years and be not spot on. The world's never perfect. The world's either better or worse than expected, but approximately correct, and exactly wrong, approximately correct. All you got to do is be in that performance zone. And then folks have credibility in the CEO's ability to lead that company, and then shake it up, right? Where you got the benchmarks, you got, the one I missed was the annual valuation, right? What's giving us lift? What's giving us drag? Maybe there's 1 or 2 things we want to work on this 90-day sprint to drive that result. So, Alf, how did I do so far?
Doing well, Professor. That was very, very good. So can we? Yeah, no, it was good. I think I'd like to make the point here that even though we're talking a lot about the financial side of things, remember what the first part of this workshop, all of this really should serve your purpose, your why. It's all tied back into your why. It's not just money for the purpose of making more money. It's really there to support a greater purpose, which is your why. So the clearer we are about that, the more motivation we've got to and follow through we're possibly going to have with regards to executing on these habits and really learning these habits, because they serve something that really matters to us as an individual, as a CEO. So the next slide here, what I want to talk to you about is, what we'd like to talk to you about is really the expectations of what your accountant or your bookkeeper does. And they're really performing, I guess, a different role as compared to what a growth CFO does. You've really got, and we've chunked it into these 4 different boxes. We've got tax preparation, which will include federal and state tax returns. So making sure that you've got your quarterly payments done, your BAS, those sort of things, and you're really compliant with what's required by the government in terms of their expectations of you being a good corporate citizen. So all of that function is a very different mindset. It requires a very detailed mind around tax law, what that looks like, what are the various case laws that come up around it. That is a role under itself. And certainly here in Australia, it's something that a lot of accountants would typically cut their teeth on, and a lot of the value proposition tends to revolve around this tax preparation activity. And if we move across to the right there, we've got the bookkeeper, who's really more of an internal, getting the numbers right within the business. So their role is not about tax preparation. It's really about making sure that we've got reasonable sort of numbers, that we know what the numbers look like, and that we're really controlling the financial reports and the sort of day-to-day transactions. And it's a very historical sort of role. So it's a backward-looking, making sure that everything's been correctly entered and that we've got historical reports that give us an indication about where the company's sort of tracking. Again, different mindset, very detailed mindset, making sure we've got our I's dotted and T's crossed for that role. And then we move across to the right. This is really the role of a growth CFO. So it's a very forward-looking growth guide, really being able to assess in the future what are the sort of right growth options to support our why, to support why we're doing things. Really making sure that the money's well managed and that we've got some sort of financial roadmap. This is taking a direction that matters to us in the future. And the goal of this is really about how do we increase revenue, and then accruals-based profit, and then really maximize the value of the business. Again, different skill sets to bookkeeper or tax preparation. So it's making sure that we've got the right person in that sort of right seat on the bus to really help us to be a partner in our growth for the future. Anything else you want to add there, Kirk?
No, just the emphasis that it really is a different role. In a previous life, I had 85 controllers and accountants working in one department, and there was not one that had kind of that Spitzgefühl to take the data and do the analysis to look at clear options for the business going forward in the marketplace, right? So it's not just in the data in the business, but in the marketplace. Even most CFOs don't operate on the level that we're talking about with this. That's why we call them growth CFOs, be it something more than that. So, Alf, I think you hit the nail right on the head.
Okay, next slide then, Kirk.
Mm-hmm.
Okay, and really what we know is CEOs primarily have 5 things that they're highly focused on, and you might just sort of tick this off in your own mind as we go through it. The first one is really about winning more customers. That's about sales and making sure that we've got a value proposition that's really enticing for our customers. So we want to be able to, as a CEO, win more customers. We want to keep the customers that we currently have and potentially grow those customers into the future. And then to deliver on that, we want to make sure that we've got the right people capacity, right, and systems to deliver on the promise and to deliver quality on that promise. So that's all around about the operational side of it. And then on top of that, we really want to have access to capital on favourable terms. And as Kirk indicated before, it's really making sure that ultimately we're achieving top percentile financial performance. And that really helps us to know, are we really at least a C student, if not a B or an A student? Because those averages that Kirk pointed out before, we're really about being a C student. A lot of certainly the CEOs that we talk to have aspirations beyond just being a C student, although just to get to that point, it's certainly a good step in that sort of road. Yeah. So, we do this really through Growth CFO Services, where we plan, implement, and really calibrate with the numbers. That's how it's done. It's teaching your team about financial intelligence and about how those numbers work. So as a whole team together, we support the CEO in their mission.
Yeah, very good. Right.
And so the difference, I guess, that certainly Kirk has evolved, and as an offering, is that really the growth CFOs under Foresight operate as a team. So it's a very team attitude versus having a full-time CFO. So a dedicated full-time CFO versus a team of CFOs. This is done on a fractional basis. Now, I think, Kirk, that in the interviewing that you've done, you believe that a virtual CFO team will outperform a full-time CFO. I think it's 4 times out of 5. Is that sort of research that you've got back and your experience, Kev?
Yeah, that's a number that we've been playing with. It's more important that a team. There's no way, at best, as a full-time CFO, at best, I have 40 years of experience, at best. If there's really, the way we come at it, there's at minimal per week, there's 2 to 3 CFOs working on helping the primary CFO have clarity and impact with that client that week. And so that's, all in. If you look at just kind of the leadership team of CFOs, there's 234 years of experience. So there's no way that somebody with only 40 years of experience, no matter how good it is, can beat that. But there's capacity. Sometimes you need a different skill set, and there's somebody who already knows how you operate that can come in and do that part of the work, because there's no way that one person can know how to do it all. So.
Yeah.
And I'll just one more thing, that the habits are proven. There's hundreds of clients globally that have benefited from these methods, where these methods actually developed out of those experiences. So they're practical, hard-hitting, and the habits complement what the CEOs are really good at and why they went into business.
Yeah. So let's just talk about the impact, Kirk, if you go to the next slide.
Mm-hmm.
So this is actual clients and a client where we're able to have a measurable impact. So you can see this particular client, we've accelerated their cash and increased their profit by about $600,000 per year through using the numbers, using the scorecards, and really upskilling the financial intelligence of the line managers. Together, we're able to increase have incremental increase in accruals-based profit by about $600,000. It really accelerated and brought forward their cash position, and the incremental value on their company was nearly $4 million. So it was quite a fantastic result for them, and who knows where the future might be in terms of their growth options, where it's going. And you can see that the cost of that. On the right is really a fraction of what's actually produced. So rather than viewing this as a cost, we rather think about it as an investment that certainly pays for itself, as you can see over time.
Yeah, very good. Yeah. So just to bring it home, we're at the wrap up. I mean, if you want to, we talked about the habits conceptually, what they are and why they benefit you. If you want to hop on a call and talk about your business, specifically what's going on and what you're trying to accomplish, literally just email either me and the kind of it's Alf in Australia or New Zealand, and then email me for everywhere else. Or I don't sleep, so I'll take the call. But seriously, we're going to send. We don't have time for questions, but we're going to send the slide deck out to everybody. But we all got a chance to really move things forward, and never before your team members, your community, your household will benefit from you. Just not put our head down in the sand. Let's lean forward. Yep.
Yep, I think that's probably a good place to wind it up then, Kirk. Certainly from my perspective, I want to thank everyone for being on the call today. And, if you'd like to have a chat about particularly about your why and how these sort of services might support your why going forward. Really delighted to have a chat. And you certainly can get either of us on our phones in the respective countries, or if you wish to email us. And of course, that 2% CEO score is, as Kirk mentioned, will be available should you want to take that, no charge at all. Did you have any parting words here, Kirk?
Yep, just I see Wendy sent us a chat, and so Wendy Roberts, I'll reach out to you.
That'd be great.
Okay.
Thank you then, everyone, and thanks for that, Kirk.
Yep, be well. We'll talk with you soon.